So we're with Peter. He's an investor in, what are your favorite portfolio companies? Spotify?
Spotify's up there. Yeah, big fan of
Snapchat?
Spotify. Snapchat was an interesting investment for us.
SpaceX?
Not in SpaceX.
Weren't you in SpaceX?
Nope.
Never?
Not in SpaceX. Nope. We were an investor in Lyft. That was the very first deal we did out of our fund, which was a fascinating investment to watch. Really an interesting case study around the power of culture, in my opinion, and how that culture can kind of permeate through your product and create differentiation that actually matters. Another investment in my prior fund was in Structure, which makes Canvas. So if you're a university student in the U.S., you're probably familiar with that product since that's where all your grades and class assignments are posted. And, we're in some really fun, interesting earlier stage companies. Like there's a company called Omaze that we're an investor in. And
That does all the giveaways, right?
That's right. They do all the giveaways. They partner with all the celebrities and do really fun videos. And yeah, it's kind of a cool company that also does a lot of good in the world.
What was the interesting part about the Spotify story?
Spotify is interesting for a lot of reasons. The thing with Spotify is that they were one of the few companies that actually were able to prove that a freemium model could work. Right? So this idea of like, we're going to get lots and lots of people on the platform and then we're going to, over time, convert them into premium users, I think it's a concept that a lot of people tried to deploy in the 2000s, in the early 2000s, and with varying levels of success, frankly. But I think Spotify figured out how to do it really well. From an investment standpoint, when we invested, they were doing about $1 billion in revenue. So very late stage growth deal for us. And yet we're growing 100% year over year, which, is kind of crazy to think about, being at that level of scale and still growing that fast. And by the time they went public, they were doing about $5 billion in revenue. So, really strong growth over our hold period, but also just kind of a fascinating story around creating a really, really great user experience, being able to convert those free users into paid, and also being able to compete head-to-head with Apple Music, which everybody thought was going to be kind of the death of Spotify, which hasn't actually ended up happening.
What has happened? What are the metrics behind that?
Behind Spotify?
The Spotify-Apple battle.
Yeah, so it was interesting is that I think at the end of the day, people continued to really like the user experience that Spotify had created. And if you think about, what does Spotify really offer at the end of the day from a value perspective, it's not the music, because when you think about when Spotify launched, people were basically getting illegal music for free, right? And so when your primary competition is free, you got to offer something really compelling. And I think what Spotify did really well is create this really great user experience, both through the app itself and the discoverability of music and everything else that made it so that, I was willing to spend $10, not even so much for the music, but just to be able to tap into a better music experience. And so when an Apple Music comes along, again, it's not because of the music, it's about this convenience and discoverability and seeing what your friends like and all of these other factors that I think ended up really mattering. And so what you saw is that when Apple Music launched, they had a ton of users sign up for that free period, but they actually lost quite a few at the end of that free period, and a lot of people either stuck with their Spotify accounts or upgraded or switched. Now, granted, Spotify Music is going to be successful because of the install base that Apple already has.
So congrats to your success. And so for this video, let's talk about how does a venture capitalist firm make money? I know that as an entrepreneur, and actually having worked with a bunch of angel investors, for a lot of people, that whole process, I assume, is pretty vague and pretty murky. And especially if you're going to partner with a fund, I think knowing how people make money can help you understand, the motives of the fund and what they're expecting and how they win and how you win.
So I think that as a venture capitalist, right, we spend a lot of our time really understanding the business model of the entrepreneur, right? But I think it's equally important for an entrepreneur to be doing their due diligence on a venture fund and understanding how that venture fund makes money. And there are definitely some nuances, but the general structure of a venture fund, you have usually a few partners that get together and they go out to investors. Oftentimes these are other wealthy individuals. It could be large pension funds. large institutional investors, sometimes university endowments. And they basically pitch them on this idea of, hey, look, invest your money with us as fund managers. We will go out and we'll identify really great investment opportunities. And those investors become what we call a limited partner in the fund. And so you have limited partners, and then you have a general partner. And the general partner is the partners of the fund. And their job is to go out and identify investment opportunities and allocate funds from those limited partners into those investment opportunities. And so you create, the fund is actually a limited partnership. And the idea that it's limited is because you don't want to have to go back to 30 investors every time you want to do a deal. So you get all these investors that come in, they put their money in, they say, we trust you with this money to do a really good job making these investments. But we're not going to give you the money forever, right? And so these funds have defined lives. They're usually 10 years long, and they'll have that 10 years is broken up into an investment period and a harvest period. And the investment period, depending on the fund, is somewhere in the 3 to 5 year range. And during that period, that's where you're making new investments. And then on the harvest side, that's where you might be putting in additional capital into your portfolio companies as they need more money and they grow, but you're not making investments into brand new companies. You're really focused on trying to harvest your investments on that second half, get exits, get companies to IPO or be acquired, and so forth. So that's how the funds are structured. And the way that VCs get compensated is primarily twofold. So one, they take a management fee. And a management fee basically is what pays salary, it pays travel, it pays for office expenses, office rent and so forth. And that's typically a percentage of the fund. Now, it could be calculated in two different ways. One way is it could be calculated based on the total committed capital. So if I have a $100 million fund, a typical management fee might be 2%. So every year, the managers, the partners, are going to be paid $2 million to invest the fund on behalf of their investors, the limited partner.
And it's $2 million every year for roughly 10 years, 20 years?
For 10 years, because the fund lasts for 10 years, right?
So of a $100 million fund, $10 million, right? $10 million is carved away for management fees.
Well, 20 million.
20 million, sorry.
So it ends up not being exactly 20 million because you're going to call that full 2% for the investment period. And then after that, the idea is that you're not working as hard anymore, so the fee will decline over time, right? So it's like, here's a bunch of money, go out and find great deals, do all your due diligence, et cetera, et cetera. And then once you've placed your bets, the idea is it's going to take less work, right? So we're going to pay you less.
So on a $100 million fund, 80 million is invested, 20 million is for management.
Yeah, I think what's probably more accurate is it's probably closer to about 15 to 17 million is pulled out in management fee. Because if you're pulling 2% for the first 5 years, and then it's to decline, the percentage will decline after that. So it's probably closer to 15 to 17 million dollars, or 15 to 17%. But that's if it's calculated based on total committed capital. It could also be based on total deployed capital, which is how much money a venture fund has actually invested. And so the amount that they're pulling out could actually be a lot less in those cases, right? But those are the primary two ways in which VCs get compensated from a day-to-day, pay the salary perspective. And then the other way that VCs get compensated is what's called carry. And carry, industry standard, is about 20% of the profits of the fund. So if I have my $100 million fund example, right, and I return that $100 million of committed capital into $300 million, right, I have to pay back all of the money that I invested, right? So in our prior example, let's say my management fee was $15 million over that 10-year period. I got to pay back all of the $15 million and all the invested capital, which would be about $85 million, right, first.
Mm-hmm. The $100 million goes back to the investors
$100 million goes back. And then once that's paid back, then I get 20%, as a venture capitalist, I get 20% of those profits. So I'd get $40 million in that case, right? If I turn 100 into 300, that leaves, pay back my original investors 100, that leaves me 200 in profit. I get 20% of that, $40 million, right? And ideally, that's the primary way that VCs make their money, right? Is based on the pseudo commissions on the performance of their investments. So that's from a high level organizational structure, how VCs make money. But the other nuance there is how the individual partners make money within the firm. And that really, frankly, varies fund by fund. But generally, it falls into two buckets. So one bucket is, if you remember, this is a group of partners that came together to raise this money. And so each one is kind of treated as an individual business unit within the overall fund. And so if I have a $100 million fund, I have 5 partners. Well, that means that roughly, right, each partner is going to have to invest somewhere between $15 and $20 million over that 10-year period. And they're tasked as an individual to go out, source, diligence, maintain board seats, all of those things on their individual deals. And so for an early stage fund, that could be, each partner is ultimately responsible for making somewhere in the like 2 to 4 investments over that fund life. And they are then compensated based on the performance of their individual investments, right? The other extreme is where the partners say, look, it's all one big pool. We're all going to work really hard together, but we all win and we all lose together. And so we're not going to be, we all make decisions together, we source deals together, and then, based on the performance of those individual investments, we're rewarded together, right? And the idea behind that is, hey, look, venture capital is one of those industries where it could only be 1 or 2 deals that really return the entire fund and drive most of the returns. And so, we don't know exactly which one of those deals is going to make it. So we want everybody kind of pulling together and doing the best they can. The other side of it is saying, hey, look, we want to incentivize each individual to go out and work their hardest and do their best. And so we're going to set up an incentive structure that helps them. And, both structures have pros and cons, but I think it's important to know as an entrepreneur which type of fund you're working with, because on the one hand, you may have a partner that doesn't have the support of the rest of his partners to get deals done. Or, when you trip up and you need to raise an additional round of capital and maybe, things aren't as glossy as you would like them to be, right? You want a partner that's going to be able to come and support you. And so, you just want to understand those dynamics, right? Also, if you're working with a fund that's a lot more collaborative, you're going to have access to more of those partners and their help, right? Versus one that's more one-off based. So it can kind of go both ways. I've seen cases where it's very collaborative and entrepreneurs had a hard time getting a deal closed because they can't convince all the other partners to be excited and have conviction around the deal. And so it's easier where it's just one partner kind of making that decision and pushing it through. But I've also seen the opposite case where that entrepreneur really needs some help and that partner just, they don't have the support of the partnership to really help the company at that point. So
are there famous funds that follow both of these structures, more of a collaborative versus a one-off? Like Sequoia, what would Sequoia do?
Yeah, that's a good question. I'm not exactly sure what structure Sequoia uses exactly.
What ones are you familiar with?
So I know that like Union Square Ventures is a very collaborative fund, right? So they all work together. So an example of a fund that's very much more based on the partner would be like Battery Ventures, which is a great fund, right? There are top performing funds on both sides of the spectrum. Again, I think it's just kind of important to understand the type of fund you're working with. I would say generally the larger the fund, the more likely it is that they're going to be more partner-based versus collaborative-based.
Okay. So funds get compensated off the 2% management fee and the 20% carry.
Yep.
How would a smaller fund versus a larger fund differ in that?
So, I think ultimately small fund, large fund, that's kind of the industry standard on those two in terms of how they're compensated.
So even if it's a $20 million fund versus a $200 million fund, do you think they're the same?
Yeah, they tend to be pretty close. So what you'll see is the management fee may creep up a little bit on smaller funds. So they may charge like 2.5%, especially if they're like a $20 million fund. Just because, if you're only charging 2%, that's barely enough to keep the lights on. And then larger funds, they'll still charge the full 2%, but they also have much larger staffs, right? So it's a trade-off. Some funds that are extremely high performing will charge even higher. They'll charge like 3% and 30% carry. But ultimately they can charge that because they've done such a good job of generating great returns for their investors over the years, that an investor will still do better investing in their fund than investing in one with lower fees. So it's a little bit of like you get what you pay for, if that makes sense. Now, the risk in it is, and there's been a lot of criticism in the venture fund industry, is that as funds get bigger, you're less incentivized by the carry because you're getting paid so much on the management fee. And so that's been a lot of the criticism around, hey, we started off investing out of a $100 million fund, and now we're a $500 million fund, but our team hasn't really grown that much. Are you actually incentivized by generating, really great returns for your investors? Or are you just happy pulling down like $10 million in management fee every year, right? So like that can be a concern. I think one of the interesting things you've seen happen lately is that venture funds, especially early stage venture funds, have realized that they're leaving a lot of money on the table for later stage growth rounds, but they also understand the economics. And they want to create something that's a win-win for everybody, right? And so what they'll do is they'll say, okay, we have our, call it $100 million Series A fund or $200 million, whatever it might be. And then we have this opportunities fund that might be $500 million. And the fee dynamics on the $500 million are very different. Oftentimes they won't charge management fee, or if they do, they charge very low management fees. And they'll in many cases, they'll even charge a smaller carry percentage because frankly, there's just not as much effort that's needed or work to go into managing that fund, because that fund is designed primarily to invest in the winners of your Series A fund, right? So you can double down on those and not leave so much money on the table that would get scooped up by larger growth equity funds.
And that would allow the funds to maintain their pro rata rights. Can you explain like what a pro rata right is?
Yeah, absolutely. So, when you raise money from a venture capitalist, oftentimes what they'll include in the terms is this idea of a pro rata right. The concept there is, as an investor, I'm going to put money in. I want to maintain my ownership percentage in the company. And I want to do that for a number of reasons. So one, probably first and foremost, like the ownership percentage that I own in the company is going to help drive the returns on the back end of this, right? The other thing that's also really important that I think gets overlooked is that my ownership percentage in the company also directly impacts the level of control I have within the company. So that, as a venture capitalist, I have more of a say of like when the company goes public or gets acquired. I have more say over different strategic decisions that are made. And if if my ownership percentage goes down over time as the company raises more money, then my influence within the company goes down. And so I want these rights in order to give me that level of influence, right, throughout the life of the company. And the right basically says that I have the ability to invest more money in every subsequent fundraising round that's relative to the amount of ownership percentage I already have in the company. Historically, what that's meant is as an early stage Series A investor, a venture fund, they may make their primary investment. And then in subsequent rounds, they'll put in a little bit more and a little bit more. But eventually, as companies take longer and longer and longer to go public and they raise larger and larger rounds, pretty soon that pro rata right can require the fund to put up like way more than they originally invested in the deal. And given the way their fund is structured, just doesn't make sense. And so that's an opportunity or a situation where they were leaving money on the table. Another growth equity fund would come in and basically invest that amount that they would have been able to invest as their pro rata and generate the returns off of that investment. And so they've launched these funds in order to capture more of that.
When like a growth equity firm, like say like a local one, Mercado, were to come in, if they were to invest or piggyback on a deal that you would have invested in, how would University Growth Fund make money off of that? Would you make money off that?
So once we've made an investment in a company and the Mercado comes in on a subsequent round.
Correct.
And gives them more capital.
And they would come in basically on your ticket, right? Or do they come in completely separate?
Well, I mean, I guess it depends on the scenario, right? But let's say we invest in like the Series A round for a company.
Because you would maintain the pro rata, right?
Right. And then they invest in the Series B round.
Okay.
Right. So in that scenario, we would have some pro rata right to reinvest in that Series B round, right? And so Mercado in this case, right, they might be the lead investor and write the largest check, and then we would have an opportunity to participate at some percentage that, or some amount that helped maintain our ownership percentage.
Right. So what you're saying is, but what if Mercado couldn't get to the table and you have a pro rata right? Could they come in
through my pro rata right?
Yeah. Is that allowed or not allowed?
Depends on how the docs are written. In some cases,
let's say your docs did approve it. Generally, is it like a common practice or an uncommon practice?
Let's say it's a common practice. I think the most common example of that is there are a lot of accelerators where they will get a pro rata right. They will give that pro rata right to the investors in the accelerator. And basically it's like, hey, look, invest in us as an accelerator. We're going to put a lot of capital into lots of different deals. And then the ones that really take off and start doing well, we'll maintain a pro rata right there, a right to invest in future rounds. We'll give that to you as our investors. So you can invest directly through them and not have to pay management fee or carry to us.
Got it. So in that case, the accelerator or like a mini VC would get nothing in the pro rata.
Right. But they got the original capital to start their fund, and they'll still get their ownership stake in the company.
Okay. How do you see the way venture capitalists make money today, and how will it be different from maybe like 10 years from now, 5 or 10 years?
Yeah, I think in 5 to 10 years, I don't think it, especially in 5 years, I don't think it changes at all, really.
Okay.
10 years is, it's a little harder to say. I think ultimately you could see some downward pressure depending on how the economy does on terms. But people have been saying that, that the 2 and 20 model is too antiquated and it's going to go away for like the past, 15 years, and it hasn't. So I think as long as the returns are there, that structure will continue to exist and VCs will continue to make money there. I think what's more interesting is if you broaden the definition of what a venture capitalist is, right?
Okay.
So if you say, okay, well, a venture capitalist could be one of these accelerator models, right? All of a sudden that kind of changes some of the dynamic. If you say that a VC is like a startup studio where they kind of help launch and incubate their own businesses, right? And almost look more like a holding company. All the way to the other end of the spectrum, where if you say these hedge funds that have entered the game, right? So like Tiger Global and Co2, there are also VCs, right? Even though they play in this like growth stage of the company all the way beyond from the time they go public and then beyond, right? If they're also considered a VC, they've got different fund structures, right? If you consider that SoftBank is a VC and you look at their fund structure and how they're compensated, which is quite a bit different than a traditional VC. So I think in those scenarios, right, like you'll have movement in terms of how VCs are compensated. But I think the core of like, I got to be able to run my due diligence and source deals and my operations, right? So there's got to be a way to fund that. And then ultimately you want to reward VCs and investors in general based on their performance, which is the carry piece.
How would a VC fund, where like their management fee, differ from like a growth equity fund?
It can really depend on the fund and how they've structured their fund. I would say in general what we've seen is that venture funds and growth equity funds continue to have a similar structure. The differences is on the underlying portfolio. So for a venture capitalist, and this is important to understand in terms of how VCs make money as well, is that the earlier stage the company, the more that power law distribution plays a role. And by that, what I mean by that is that you will have very few investments as a venture fund that drive the bulk of your returns, right? So if you make 10 investments, you'll have probably 2 or 3, maybe 4 that are you just lose all your money on. You'll have a few where you get kind of what we call doubles and singles and maybe triples, where you get 1, 2, 3 times your investment back. And then you'll have 1 or 2 that return just a massive amount. They return more than all of the capital that you invested in all 10 deals, right? And you need that one because every deal you're doing is incredibly risky, which also means that you are basically shooting for the moon. You have to shoot for the moon on every single deal. And so, I think a lot of entrepreneurs, they'll go and pitch VCs and they're disappointed when they're not able to raise money in spite of the fact that they have a great business, because the VC ultimately is looking at it and saying, I don't see a story where that company can get to be $1 billion company. And if they can't, they don't have the potential of getting to $1 billion, then frankly, it's not worth my time. Now, that doesn't mean that you have a crappy business, right? Because you could be like, well, geez, like I can grow a business and be worth $50 million and get acquired and have a great outcome and be very happy with that, right? But ultimately, that's not a big enough driver for a VC, right?
Okay.
But as the company progresses, right, the risk of that company failing goes down, hopefully. And so as a growth equity investor, you're not looking to make, 10, 20, 100 times your investment on that deal. But you also don't have the risk of, half your portfolio going under, right? And so you're targeting investments that are going to generate somewhere in the 2 to 5 times your investment range, right? With very low likelihood of losing money.
Are they still taking a 2 and 20 model though, generally speaking, for growth equity?
Generally, yeah.
Would private equity funds going further up the ladder do the same thing?
Yeah, most private equity funds are pulling about the same, 2 and 20.
What about accelerators?
Accelerators are a little different. You might actually have more insight on this than I do,
I haven't touched
John.
an accelerator for like 10 years, so I wouldn't know.
I honestly don't know all the ins and outs of accelerator structures. I wouldn't be surprised if they have what's called more of a budget-based fee model, where they say, here's our budget, and investors fund that budget rather than just giving them a set percentage of the fund, in part because usually accelerators aren't raising a ton of money to make investments. They're raising that money to provide support and other services to startups, and so they get compensated not only for the money they put into the company, but also in exchange for those services. And so it's a little more convoluted of a model. Whereas a venture fund, like as a VC, you may add value to your startup, right? Every VC likes to claim that they add a lot of value to startups. But the honest truth is that your returns are going to be generated based off the cash you invested, right? You don't get extra because, you were a really nice guy and helped make some introductions, right, that were helpful.
Andreessen Horowitz is a whole introductions team, right?
Yeah, no, they have a whole support team for all kinds of things, not just introductions. They'll help you with hiring and marketing and branding and sales and all kinds of stuff.
And with their model, would they still be at the 2 and 20, or are they more like a 3 and 30?
Yeah, that's a good question. I don't know the intricacies of their fund structure. But what I do know is that they don't charge more to their startups for all the services they provide, right? For them, it's like, hey, look, come to us, and not only will we give you capital, we'll give you all this extra support. And what they're saying is, look, we're going to take our management fee, and instead of paying our partners huge salaries, we're going to pay them, reasonable salaries. But then we're going to take what's left of that management fee, and we're going to hire a ton of support staff to help out our portfolio companies.
What would be the average salary of a venture capitalist?
There's a lot of good studies out there. It kind of depends on what stage you are, right? If you're a managing director or if you're an analyst at the bottom. But salary, and then the size of your fund, right? So if you're managing a very small fund, let's say you're managing a $10 million seed fund, and you're pulling 2% of that, that's only $200,000, right? And you got to run everything. So you got to pay yourself, you got to pay your office, travel, right? Like all your legal expenses, etc. So in that case, it could be really low. You could that partner may only be making $50,000 to $100,000 a year, but you could go all the way up to the range where partners are making million plus a year. So I would say in general, though, it's like of a decent size Series A venture fund, they're probably making somewhere in the $250,000 to $500,000 a year range.
And then they would get the carry on top of it.
And then they'd get carry on top of that. Yep.
Awesome. What other questions should we know about how venture capitalists make money?
I think the other thing, just in terms of how venture capital firms make money, that's important to know is how does a venture capital fund make a decision, right? And if I were an entrepreneur, that would be one of the diligence items on my list, is how do you make investment decisions for the first time investment, and how do you make follow-on investment decisions?
It's with a Ouija board, right?
It's a little bit with a Ouija board. Well, I mean, it can feel that way, and that's because a lot of funds make decisions a little differently, right? Some funds, it's like, hey, I'm the partner, and I pitch it to the rest of my partners, but really, unless there's just something that they all hate, it's going to go through, right? There are other situations where the entrepreneur is invited in and they pitch to all of the partners, and that's the investment committee decision, right? So the main partner is doing a bunch of diligence, but ultimately the decision is made when the entrepreneur comes and pitches to everybody. So it really kind of just depends, but it's something that you want to make sure you understand, especially early on in the process, so you know whether or not like you're moving through the process or not.
Okay. That's always true. There should be a map. Is there a map out there that shows that?
That would be nice. But again, the problem is that every fund's a little different, right?
But you could map out every fund and say, here's the general process.
You could if the venture funds are willing to like share all that information with you.
Someone should publish that.
Somebody should publish that, probably.
Someone like you might know. All right. Well, how should we wrap up this interview? Any other questions anything we should know about typically there's the carry and the management fee.
Yep.
Usually the management fee, whether it's a small VC or large VC, they're making 2% each year for 10 years. And then there's the 20% carry off of profits that the partners at the fund would then share.
Yeah, and there's a question around like how is that carry allocated, right? Is it allocated? Everybody gets a split amount, right? Everybody's treated equal? Is it the founding partners get more than the junior partners?
How is it generally broken up?
It's hard to say generally. Again, I think you have kind of the two ends of the spectrum. One end of the spectrum is the founding partners are taking the bulk of the carry, right? And on the other end of the spectrum is everybody gets an equal share, right? I will say it's important to understand, if possible, now sometimes VCs will be reticent to share this, but to understand how that's broken up. Because if you're working with somebody you love and they're just amazing, but they are they are considered a junior partner and they're not getting compensated the way that they feel that they should be compensated, you do run a risk of that partner being either leaving and launching their own fund or being stolen away by another fund that's willing to compensate them accordingly. And I've seen that happen several times in my career where, there was an investor that came in that was super gung-ho and bullish on the deal, and but ultimately was considered kind of junior, and in spite of the fact that they were a rising star, never felt like they were being compensated the way they should have been, and so they ended up leaving. And that left the startup in a bit of an awkward situation, right, where they had really lost their champion within that fund, and the guy that came, the man or woman that came in to replace them wasn't as, didn't have as much conviction over the deal as the prior partner did, and ended up really hurting the company's ability to raise capital from that fund. So, it's one of those things that probably people don't think too much about, but does happen and is worth being aware of.
How do you prevent yourself from being in that situation?
I don't know that you can prevent yourself from being in that situation, but it's like all risks in startup land, right? Like there's some things you can mitigate and some things, you just take the risk on knowing that it's a risk, right? Clearly the way you really mitigate it is you just refuse to take money from a junior partner, right?
Okay.
But that can be tough, right? Especially if you really connect well with that partner and you don't have a lot of other options, right? It just kind of is what it is. But I think meeting with the other partners of the firm, developing a relationship with the other partners so that if something were to happen with the partner that you're working with, you have a strong enough relationship with other people there that can step in. I think those are all great ways to mitigate that risk.
Awesome. Well, thank you for your time, Peter, and teaching us how VCs make money.
Yeah, my pleasure. Hopefully it was interesting.
Super interesting. Make sure you like, comment, and subscribe. Again, this is Peter with University Growth Fund, ugrowthfund.com, right?
That's right. Yep.
And they've invested in Snapchat, Spotify, Lyft,
Pinterest.
There's a whole board over there that shows it.
A whole bunch.
Well, cool. Well, thanks, Peter.
Thanks for having me.
All right.